Welcome to Skytech-Lens. In recent years, a remarkable wave of American companies, such as Coca-Cola, GM, Ford, Tesla, Alcoa, and Campbell Soup, has been making headlines for a surprising reason. These industry giants have begun relocating significant portions of their operations north of the border, choosing Canada as their new base for manufacturing and innovation. This isn't just a passing trend or a temporary experiment. It's a calculated, strategic response to a complex web of mounting economic pressures and rapidly shifting government policies in the United States. As the U.S. grapples with internal challenges, ranging from rising labor costs to unpredictable trade policies, Canada is stepping up, positioning itself as a new hub for industry, technology, and forward-thinking innovation. For these companies, the move isn't just about geography. It's about finding environments that offer better operational efficiencies, more stable economic benefits, and a friendlier climate for long-term growth. The implications of this shift are profound and far-reaching, touching the lives of factory workers, reshaping entire communities, and sending ripples throughout the broader North American economy. For policymakers and business leaders alike, understanding the reasons behind this migration is more important than ever, as it could influence future economic strategies and labor policies. Let's unpack the key factors driving this northward migration: rising tariffs on goods, fluctuating energy costs, evolving regulatory landscapes, and attractive economic incentives offered by Canadian provinces, all of which are reshaping the competitive landscape. Canadian governments are rolling out the red carpet with tax breaks, grants, and business-friendly policies, making the country an appealing destination for multinational corporations seeking stability and growth. So what does this mean for the future of U.S. manufacturing? The answer could redefine the industrial landscape of North America for decades to come. U.S. tariffs on steel and aluminum have driven up manufacturing costs, making it increasingly difficult for domestic manufacturers to stay competitive in the global market. These tariffs, intended to protect American industries, have had the unintended consequence of raising the prices of raw materials. As a result, many factories are seeing reduced production rates and in some cases complete shutdowns. The increased costs make domestic production less attractive, pushing companies to look for more cost-effective solutions elsewhere. For example, building a pickup truck in the U.S. now costs about $1,000 more due to pricier steel. This significant increase in production costs is not something that can be easily absorbed by manufacturers. These costs are inevitably passed on to consumers, resulting in higher prices for American-made products. This not only affects consumer purchasing power, but also hurts the competitiveness of American products in both domestic and international markets. The Detroit Automotive Economics Institute warns that if these tariffs persist, the U.S. auto industry could face losses of up to $180 billion. This would have a devastating impact on the economy, leading to job losses and reduced economic growth. Many companies can't absorb these costs, so they're moving operations to Canada, where such tariffs don't apply. This relocation allows them to maintain profitability and continue their operations without the burden of increased material costs. This shift helps them stay profitable and competitive. Canadian facilities are benefiting from this influx of business, leading to job creation and economic growth in Canada. As long as tariffs remain, the trend of relocating north is likely to continue. This ongoing migration could reshape the manufacturing landscape in North America, with long-term implications for both the U.S. and Canadian economies. Canada offers American companies several key advantages. Industrial electricity rates in Quebec are as low as 3.68 cents per kilowatt-hour, less than half the rate in Detroit. The Canadian government's Rapid National Interest Projects Act slashes permit approval times from 2 years to just 90 days. This efficiency saves companies time, money, and uncertainty. Canada's abundant hydroelectric power also helps companies meet global sustainability standards. Lower energy costs and clean power make Canada a prime destination for cost-conscious, eco-minded businesses. Streamlined regulations and access to renewables are a powerful draw. As efficiency and sustainability become priorities, Canada's appeal will only grow. Major U.S. companies are already reaping the benefits of moving north. In recent years, a growing number of American corporations have shifted significant parts of their operations to Canada, drawn by a combination of lower costs, reliable infrastructure, and a skilled workforce. This trend is transforming the business landscape on both sides of the border, as companies seek new ways to stay ahead in a competitive global market. Take General Motors, for example. The company recently invested $2.6 billion in Ontario and Quebec, a move that not only preserved 500 high-quality jobs, but also set the stage for future growth. GM plans to produce 400,000 Ultium drive units annually at these Canadian facilities, supporting the shift toward electric vehicles and sustainable manufacturing. This investment highlights how Canada's advanced manufacturing sector is becoming a magnet for innovation and job creation. Coca-Cola is another major player making the move. By shifting production of 800 million cans to Canada, the company is saving nearly $50 million a year on electricity alone. These savings are possible thanks to Canada's abundant and affordable energy resources, especially in provinces with clean hydroelectric power. For companies with energy-intensive operations, these cost reductions can be a game-changer. Tesla too has recognized the advantages. The company built a massive 10 gigawatt-hours battery plant in Quebec, drawn by cheap hydroelectric power and a business-friendly environment that encourages innovation. This facility is helping Tesla meet the surging demand for electric vehicles while keeping production costs in check. These strategic moves allow companies to cut costs, streamline operations, and remain competitive in a rapidly changing world. By relocating or expanding in Canada, businesses can access new markets, benefit from favorable trade agreements, and tap into a highly educated workforce. The savings are real, and so are the jobs and investments flowing into Canada. Local communities are seeing new opportunities from construction and manufacturing to research and development as these projects take root and grow. As more companies experience these benefits firsthand, the northward trend is set to accelerate. The cross-border flow of goods, talent, and capital is reshaping the economic relationship between the U.S. and Canada, creating a more integrated and resilient North American market. The industrial landscape of North America is being reshaped before our eyes, with Canada emerging as a key destination for investment, innovation, and sustainable growth. Canada's government is actively courting U.S. companies with bold incentives. Tax breaks, wage subsidies, and infrastructure investments are on the table. Up to $52.5 billion CAD is pledged for a domestic EV battery supply chain, luring manufacturers north. Clean energy infrastructure and abundant hydroelectric power help companies meet sustainability goals. Streamlined regulations make it easier and faster to set up shop. These strategies create a competitive, predictable environment for international businesses. As global competition heats up, Canada's proactive approach is paying off. The move north comes at a cost for American workers and communities. GM's relocation means 1,300 layoffs in Michigan, with suppliers like Cleveland-Cliffs cutting another 1,200 jobs. Factory closures ripple through local economies, leading to lower spending and economic stagnation. Towns once thriving on manufacturing now face empty factories and declining business. Job losses hit property values, tax revenues, and community morale. Retraining programs and economic diversification are urgently needed to help affected workers. Without action, the social and economic fabric of these towns will continue to fray. The U.S. must find ways to support its workforce through this transition. The exodus to Canada forces the U.S. to rethink its manufacturing future. To stay competitive, the U.S. must reconsider tariffs, invest in infrastructure, and streamline regulations. Reducing trade barriers could ease the burden on domestic manufacturers. Investing in technology and innovation will help keep U.S. manufacturing viable. Adopting faster, more predictable regulatory processes, like Canada's, could attract and retain businesses. The future depends on policymakers and industry leaders adapting to new realities. With the right strategies, the U.S. can remain a global manufacturing leader. The time to act is now. The U.S. to Canada shift is part of a larger global trend. Companies are crossing borders in search of better conditions, highlighting the interconnectedness of the world economy. Countries with favorable policies and efficient regulations are becoming global business hubs. This movement will reshape trade relations, especially between the U.S. and Canada. Ongoing dialogue and cooperation are essential to ensure mutually beneficial outcomes. The ability to adapt and stay competitive will determine who thrives in the global marketplace. Understanding these shifts is key to future economic success. The relocation of U.S. companies to Canada is a complex, far-reaching development. Economic factors, tariffs, energy costs, and regulatory efficiency are driving the trend. Canada's incentives and infrastructure investments make it a top choice for business. The U.S. must adapt by reducing barriers and investing in competitiveness. Global cooperation and adaptability will be crucial as the economic landscape evolves. By understanding and responding to these changes, both countries can seize new opportunities. The future belongs to those who adapt and innovate. Thanks for watching. Subscribe the channel for more updates.